When we look at the future and what is going to happen in the US, it's always important to, obviously we talk about the consumer, but small businesses is going to give us a very good indicator of where things are going. And when you look at inflation still remains the single most important problem. And that actually increased. So it's actually up from where it was, where inflation was becoming a little bit less of their concern. And you're starting to see it accelerate a bit as we got into the end of October. And that's interesting because you did see, again, with the CPI number, you saw inflation get a little bit better. And again, it still went up, not as much as expected, but it still increased. So clearly there is still a concern within the small business community that inflation is biting into what their concerns are as we go forward. Quality of labor still remains an issue. But in all of this, in terms of inflation, but also rates, when you look at Capex plans, they continue to diminish. This is just showing you that companies are less likely to spend as we progress through not only this year, but into next year, because you're planning right now. So November 10th, 2022, you're not planning your Capex to spend in the next 6 weeks. This is referring to, okay, what am I going to do next year? What is my 2023 plan? Because you're in planning mode of, we're going to close out the year, see how much Capex we spent, if we were over budget, under budget, and then we're going to figure out what we're going to do next year. And here is where you're seeing that diminish. And we've been seeing that fall throughout 2022, which puts a bit more pressure on what the economy is going to do. What kind of investment are we going to see? Then when you take this and look at small business higher prices, they're seeing prices remaining elevated. Inflation clearly not denting small business sales, so sales are still there. Many still report high prices, but barely any report weak sales as the single most important problem. So again, prices have come down, but when you go back through 2000, they're still at the highest level that we've seen. And that's I should say historically, obviously it was higher in 2021, but you're still seeing a lot of pressure to the upside, and it's still in expansionary territory, which is why we see some of these underlying problems. But then when you look at rent delinquency, U.S. states where rent delinquency rates were the highest, Massachusetts, Jersey, New York, California, Pennsylvania, and this is going to lead back to small businesses. How many of them could pay their rent? And if they can't pay their rent, well, is it because rents went higher and sales prices aren't covering it? Is it because sales are slowing so they can't cover rent? And again, rent is the biggest issue because a company can't afford to get evicted, and if they get evicted, then what? So when you look at some of the different data sets, they start to contradict a bit because yes, higher prices are there, but yet they're still struggling to pay their rents to keep things moving through, because this is the rent delinquency rate amongst small businesses. So again, there's some of these concerns where it's like, oh, well, high prices aren't a problem. My sales are fine, but yet you can't pay rent. So again, this is why we want to flesh out some things to look at when we're talking about the health of the economy, especially as we go forward. Share of small businesses seeing higher prices continues to roll over, while the share expecting to raise prices in the next 3 months has started to reverse back up. So again, back to rent. So now you're actually seeing, okay, well, higher prices are coming down, but you're starting to see more companies raise prices again. And if you look, the number 34, that's the highest it's been since 2007. And before that, this is the second highest it's been, obviously outside of 2020. So you're starting to see that creep back up. Again, back to the inflationary point, back to the point of, are they starting to see inflation creep back up a bit? Or are they starting to see some of that, again, that flatlining, that stagflation that we've been talking about? So then when you look at October small business Optimum index moved down to 91.3 versus the estimate of 91.4, and it was 92.1 prior. So again, you're starting to see a lot of concern. Outlook on the orange side dipped as well, but remains off the cycle low. Hiring plans eased while expectations to boost compensation moved higher. But we want to look at what the companies are saying about compensation and what the workers are expecting, because there is a very big difference in terms of those views. Interesting convergence in small businesses raising compensation, which is blue, versus those expecting raised compensations, orange. So when you look at it in small businesses, raising compensation is the blue side. So they're expecting to still raise it, but not as much. But people are starting to expect it. When you look at that yellow line, and it's coming to the highest it's been since obviously 2020, but before that, that's the highest it's been since 1985. And that's a concern because, well, are they struggling to pay? Are they struggling at pricing? And that's when you start coming down to, where is the living wage? Where is living costs? Credit conditions getting tougher for small businesses, with the index hovering near the lowest in almost a decade. So small businesses are struggling to get credit. If they do get credit, it's at a higher rate. So higher rates are going up. Rents, delinquencies are going up. Prices are remaining elevated. Likelihood of increasing prices starting to tick back up. And wages, compensation plans are starting to tick down, but still elevated. So again, all of this is still showing me that we're in an inflationary juncture, but leading more into a stagflationary problem. So small business compensation plans, just kind of looking at this a bit more clearly, small business price plan, and how much of this is linked. So you're increasing compensation again to the highest it's been since 2021. How are you going to afford that? Well, you're going to raise prices. So as that again, this is some of that stagflationary standpoint, because yes, supply chains have improved. Costs for shipping, especially on the open ocean, have come down. You're not getting tender rejections, as we talked about in segment 1. That is deflationary, but this is inflationary. Again, coming back to our stagflationary view. Inventory too low. Firms reporting inventory too low. You're starting to see that things are getting back to normal. And that's when you start looking at, well, inventories are getting back to normal. Now I can start to try to plan a bit better, but credit conditions are coming down, which is also leading to the reduction in Capex. Well, if credit conditions are getting tough, I can't borrow. So why am I going to spend Capex? My inventory is back to a normal standpoint, so I really don't need to invest anymore because I'm starting to get back on my feet in terms of where things are on the inventory front. But then when you look at revolving consumer credit, it's obviously blown through pre-COVID levels, and we're back on track in terms of where that credit is. The problem is the cost of that credit. And the fact that we've already drained savings, we've already drained all of these excesses. So people are maintaining this off of their credit cards. U.S. outstanding consumer credit, you can see that at every level from every point of consumer income levels, credit usage is surged. So when you look at people from the 60th percentile to the 99th percentile, you're getting these big increases because people are trying to maintain their standard of living, but the costs of doing so are going up. Because when you look at outstanding consumer credit is moving higher, but even as it moves higher, that cost of it goes up because rates are going up. So ARPs are going up. Again, all of this leading to draining the purchasing power of the U.S. consumer. Merchant wholesale inventories moved up by 0.6% in September, while sales increased by 0.4%. Former has seen fairly consistent declines this year. So again, you're starting to see that balancing act in terms of where things are and getting to some of that normalcy. Now, this one I thought was a really good chart looking at staple spending is eating away at discretionary spending because it's costing me more to do things I need to survive, like food, energy, electricity. So that means that there's less money to spend on the discretionary front. And that's why we continue to see this divergence. And that's where it's going to put more pressure on what people are willing to spend as in the on the holidays, and as we look forward in terms of what the consumer is going to be spending in the longer term. U.S. revolving credit up by $8.3 billion in September, non-revolving credit up by $6.6 billion. Former saw slower growth from prior month, while latter saw stronger move up, but all moving higher. And again, all of this is showing just what is hitting the consumer. Now, with all of this being said, capital markets activity in October was the worst since 2011. Why? Because it's near impossible to try to get debt at a normal, just in general credit ratings. So the pressure is there, and this is impacting the way people can do business. Downside pressure on yields. When you look at, again, that slowing growth, that slowing demand, the economic side, that's where there should be more pressure on where the 10-year is going. My concern is more on just the trading front of just the sheer amount of paper in the market that is going to continue to keep yields elevated, because you have to incentivize people to spend, especially because capital markets have slowed down. So the availability of corporate debt is dwindling. Where are you going to go try to find value? And that's when you start to see some of these movements into the government sovereign debt side. But again, a lot of these different pieces are going to be important. But the capital markets is also showing you, coming back to small businesses, you're just not seeing the borrowing and the availability of capital, which is why Capex is slowing, why you're not seeing companies invest the same way. U.S. credit card spending by category has started to come down in terms of the levels. We think that that's going to continue, but real consumer spending still remains fairly flat. And that's where there has to be that connection and things. And this is why we said back in October that we thought October was going to be the first period of real U.S. consumer spending declining. And that's being supported based on the credit card data, the inflation data, real wage data, which is why we remain concerned about the economy in Q4, but more importantly in 2023. U.S. housing cost to income ratio, obviously exploding higher. Asking rent as a share of disposable income for 25 to 34-year-olds at 41%. Highest since 2018, and moving back to the upper level, which is again going to make it difficult for people to put down payments, especially because prices have gone up so much. You need to put down a bigger down payment to keep your monthly costs reduced because of some of these underlying pressure points, which again is resulting in less mortgages being sought. Is existing home sales falling faster today than during the great financial crisis? And I think that's a concerning view when you look at where some of this pivot is and how quickly these adjustments are happening. U.S. home prices leading 18 months versus CPI for rent. So again, you're starting to see that kind of double dip, but you still had a little bit more upside before we start to roll over, with U.S. bank lending standards and demand for mortgages obviously collapsing. Then you look at the year-over-year home price appreciation, it's still positive. And that's important because it's come down, but it gives you an idea of how much additional space we have to decline, which is why we see a lot of downward movement on the home front. Effective rents cooling, but it's a matter of when does the CPI catch up and then start to reflect some of these reductions. Then when we take this and we look at a very unfriendly trend for non-farm productivity and unit labor costs, the 6-month annualized percent change for former is at the lowest, most negative since early 1980s, with the latter highest since early 1980s. So when you look at it, you're seeing productivity collapse while costs are still elevated, which is why there's such a pressure on small businesses and businesses in general trying to maintain productivity, but they have to pay up for it. How do you afford that? You raise prices, and that's where you're starting to see that balance out once again. But one of the interesting things is on the non-farm payroll. So the non-farm payroll is looking a bit strange because households basically say that no employment growth since March. where the NFP says that it was up by 2.5 million. The net birth to death of business numbers and again, the seasonal adjustment, but there's some of this concern, and typically it works itself out. But we want to dig a bit deeper into the NFP versus the household survey piece. So here you can see that, well, PMI is telling me that employment is contracting. So employment's contracting. So doesn't that mean that we should start to see that come down? Meta, several banks, obviously, and FTX, you're starting to see a lot of these problems and a lot of these layoffs increasing while prices paid are going back up. And again, just flatlining, but it's expanding. So employment is contracting. Wages are going to come under pressure because we're seeing layoffs, but prices are going back up. Again, seems more stagflationary to me. Input price for the service side continues to move up. ISM manufacturing and services prices paid. When you look at some of the different pieces, services still remain at this massive expansionary territory, which is inflationary at heart. But it's important to go back to the non-farm side. So when we look at the payrolls, so the cumulative sum over the last 6 months shows that non-farm payrolls were up over 2 million. But then when we look at household survey, it was only up 500,000. So similar to June and April, another divergence in October between NFP and household survey. But the birth death model estimates birth and death of businesses was 455,000 last month. And now why does this matter? Employment estimates from the payroll survey are a count of jobs, while the household survey provides an estimate of the number of employed people. If a person changes jobs and is on the payrolls of 2 employers during the same reference period, both jobs would be counted by the payroll survey. So if you get laid off and you get severance, but you get a job right away, well, you show up on 2 areas. If you quit and go somewhere else, you'll show up on 1. If you take a buyout and you're working somewhere else, again, all of these are going to, and that's why it normally works itself out, because eventually that severance is done, you'll show up only here. And those are important pieces to watch to see where does this kind of catch up. The household survey, on the other hand, will simply reflect 1 employed person in a measure because you're not having 2 jobs. Now, if we take it out 7 months, you can see that the non-farm payroll, it shows an increase of 2.45 million jobs, with the household only showing an increase of 150,000. When we look at the employment data and PMI and these other regional feds, it's something that would be closer to the household survey, but this is going to be an interesting one to watch as we go forward. Unit labor costs, again, was expected to be up 4%, came up 3.5%, while labor productivity missed to the downside. So again, more stagflationary for the company. This is that breakdown of the household survey and the household employment versus payroll employment. Again, you're starting to see some of those disconnects. But I show this chart just because household survey data went ahead of non-farm payroll data at the big pivot when we had that reopening acceleration in 2021. Now you're starting to see household survey leading to the downside with NFP showing to the upside. So typically household data turns better. They're always lumpy, as you can see, but the household survey we think is showing a bigger issue and slowdown on the job front that the NFP hasn't caught up to. Average hourly earnings, so slower growth in average hourly earnings suggests other wage metrics will continue to ease. Later adjust for mixed effects. So inflation slowed, but it was still expansionary, while wages are already rolling over, but in some areas they're going back up. So again, a lot of this is still showing that stagflationary backdrop. Employment diffusion in terms of the breadth of industries coming back down to more of a normal, which is expected to see. And then looking at the non-farm payroll side, you can get an idea of where some of the numbers came in. Then when we look at HPI, the forecast change year over year, there's some expectations that prices won't come down as much on the view that active listings are flatlining and this shortage of availability We don't believe this as much just because we see a lot of the other data sets in terms of mortgages. And in order to get people to come for that pricing to bounce, you would have to see rates come down sooner, which we don't expect. Then when you look at the U.S. trade balance in general, you can see that the trade deficit reversed in September and expanded to $73.3 billion versus the estimate of $72.2 billion in terms of the deficit. And it's all going to be driven based on where are imports, where are exports. So this is something that, as we said during the Q3 GDP number, we had a big benefit from exports and the export import, and that's going to start to unwind in Q4, putting some downward pressure on U.S. GDP numbers. So that's what we have for you for the rest of the U.S. In the next segment, we're going to go deeper into Europe and where some of those economic drivers are sitting at the moment.